Okay, so today I'm here with Zane Schartz, and he is a former and sometimes pro hockey player turned private equity guy. So he currently runs the Freedom Commercial Real Estate Fund, and he is just a great example of how doing the right thing pays off in the long run. So Zane has a great story, a great background, and he gets into the interview on how using a tool like ChatGPT can help you review all these documents that you have to look at when you're looking at alternative investments. So if that's something you think might be helpful, jump into the description, download my free How to Use ChatGPT for Due Diligence guide. And without further ado, let's hop into the interview. Okay, Zane, thanks for being here. Why don't we just start off with telling people what makes Zane Zane, and what do you do?
So what makes me me first?
That's a big question.
The most important thing about me is my faith.
Great.
I'm a believer in Jesus Christ, and that's what makes me me. Everything is a byproduct and outflow of that. From a just life and business standpoint, I'm from Dallas. Grew up in the Dallas area. Grew up playing hockey. It's a big part of my life. Played hockey throughout growing up, college. Played professionally after. And then I knew at some point hockey was going to come to an end. So I knew in college I'd probably be wise to start looking at the next chapter. And I realized that chapter was going to be real estate, and started doing some internships in different parts of real estate. I did development, brokerage, and private equity internships, and kind of landed on the private equity side of that's what I wanted to do. So ended up working at a private equity firm for about 6 years and was the chief investment officer there. We grew from $100 million of assets to $750 million in that time period. So it was a good time, good experience to be part of growth. And then about 2 years ago, it was just time to start the next chapter. And that's when I started Freedom Commercial Real Estate. And what we do now is we create cash flowing real estate opportunities for investors through double net and triple net assets with investment grade tenants. So kind of loaded answer, but
yeah, no, it's a big one, and obviously you're here primarily to talk about double triple net type stuff. But I want to ask you about your hockey career first, because I was just kind of dinking around, and when we know each other personally, but it's like, well, when someone Googles Zane, what comes up? And a lot of times it ends up being their big investor websites or their this or that, and that's all they are, right? That's their whole personality. I found a website that was like Zane's stats, Zane's hockey salary, all this stuff, and I'm like, So tell me, let's talk about your hockey career first. I want people to get to know you a little bit.
Yeah, I mean, man, hockey is such a big part of my life. I love the game. I'm still involved in it. I still play a little bit. Yeah.
Well, you told me that you were in, was it Germany earlier this year? Or
yeah. So I was in Germany as recently as of this year. Played for a couple months and played in a pro league over there. My team won the championship, so that was pretty fun.
I thought I saw a picture of you, hands in the air with the trophies. So
yeah.
So how does that compare to like the Stanley Cup?
Oh man, it's my Stanley Cup. Let's just put it that way.
Okay. It's the German Stanley Cup.
Yeah, pretty much. But yeah, so my hockey is a big part of my life, and yeah, when you Google me, a lot of my hockey stuff comes up, and it will be for the future. Like I would like to get on the ownership side of sports in the future. I'm a minority owner on a pro sports team right now in the minor leagues for hockey, so that's been fun. And in the future, ambitious goals, would like to be a NHL owner of some capacity. So I love hockey. It's a big part of my life. I played in Europe, Germany, Hungary, Finland, and played all over North America, and played in different NHL organizations, but never made it to the NHL, and just kind of was a journeyman in the pro hockey world. So met a lot of great people. It instilled a lot of, different characteristics and attributes that I think have transitioned really well into the business world.
Yeah, I think one of the primary things people might think of is kind of like that dedication. Like you have to be dedicated. You have to work really hard to get to that level. Even the level you're playing at, right? What about how has that experience and that network impacted like your business career? Like, have you made good business connections that way? I know that's not why you're doing it, but what's that been like for you? That overlap?
Yeah, I'd say like a two-part answer is the first one is from an investor standpoint. A lot of my friends played in the NHL, and I know a lot of players in the NHL, and obviously NHL players have a lot of money. So
Yeah.
we have some some NHL investors, and they tell their friends, they tell their friends. We also have NFL investors, so we have a lot of professional athlete investors, and I can relate to them since I played pro sports. And then from a just kind of business standpoint, everybody likes to talk about sports. So you get on a call with somebody and hockey comes up and they're just like, what? You played pro hockey? And, it's just a cool kind of like connector. And, a lot of people in kind of the real estate world played sports at some capacity. I'm sure you did. And,
I didn't get past 10th grade though, so that
great, but we can
just
still connect.
yeah, yeah,
Sports are a great way to connect with people, whether you're a
yeah.
fan or a player or whatever. It's a really
Yeah.
great way to connect, and I'd say from that standpoint, it's been really good. And sports are a great connector for business and just personal.
Okay. Yeah. So what's your second favorite sport behind hockey?
I love watching NFL football. It's probably my favorite sport to watch.
Okay.
I can veg out on a Sunday and just watch the games. And I'm not even like a super like fantasy sports guy, but I love watching NFL football, and I'm a Chiefs fan. So
Okay.
I was born in Kansas, so I can
Okay.
take
I was
it.
going to ask, so how'd you become a Chiefs fan then?
Well, I
So,
mean, long story short, I was a Cowboys fan for 20 plus years, and when they signed Dak to that second contract, I was like, I'm not doing this anymore.
okay.
So, born in Kansas, I can take that.
Okay. All right. So, yeah. So tell me, let's go into a little bit more detail just on how you got Freedom CRE. That's your current, real estate investment group. Tell me a little, let's dive into a little bit of like how you got to where you are. What are the important notes for people to kind of understand of how Zane became the guy he is in Freedom CRE?
Yeah. So I'd say like a big part of my business growth was at that private equity group I worked at for those
Yep.
6 years, and we had three kind of branches. We had existing multifamily value add stuff. We had development.
Which a lot of people are going to be familiar with,
Yep.
multifamily.
Yep. Multifamily value add, standard kind of C class to B class plays. Lots of variables, kind of lots of upside,
Hmm.
but just lots of variables in that. We had development, ground up development, and then office space conversions, and then we had these triple net funds, which I ran at that company. So I learned
Okay,
a
so you
lot.
ran like a business silo of a larger funds
Exactly.
structure.
So we
Okay.
pretty much had like three silos, and I ran one of them entirely, and basically had my own business within a business, which was awesome,
Okay.
and I loved it. Um, and then when I left and created Freedom Commercial Real Estate, I really wanted to create something that was, well, let me back up. At that old company, I saw the variables of development and I saw the variables of value add multifamily. And some of them are controllable and some of them are not controllable.
Hmm.
And what we were seeing is that the uncontrolled variables and even some of the controlled variables were affecting our returns and our projections because there's some stuff you just are out of your control. So investors weren't getting the returns that were projected. There's probably two sides to that. One, we could have been more conservative on underwriting, and two, there's stuff that's 100% out of our control. So,
Hmm.
um, when I started Freedom Commercial Real Estate, the term freedom means two things. One, we want to help investors on their journey towards financial freedom, and two, back to my faith, I think that true freedom comes through faith and trust in Jesus alone. But the first part, the financial freedom side, is I think that cash flow, stability, consistency, capital preservation is really the key to financial freedom. So I wanted to
Hmm.
build something that allowed investors to have so stable distributions that they could live off the distributions. So that is what the triple net space is the consistency and stability behind high investment grade tenants, high quality triple net tenants is really what we wanted to build. So we run everything as a fund. So investors invest into an offering which has 10 to 20 different assets, which
Hmm.
creates diversification across all of those for them. And every asset is backed by a multi-billion dollar publicly traded company. So stability is really what we wanted to build. And that's what we've been building.
Yes. All right. I want to take it even a step down to even like the foundational level. So, some people on here, a lot of people probably will be familiar with what you're saying when you say triple net. But for maybe you got the new guy, they're the high income earner, the small business owner who's just now venturing into kind of this alternative space. Um, Describe triple net and maybe double net
for the dummy, explain it to me like I don't know what I'm talking about, because I probably couldn't explain it like you could.
Yeah. So a triple net lease means it essentially means almost all of the operational overhead, operational expense lies on the tenant. So in, net, net, net means the tenant is responsible for taxes, insurance, and common area maintenance of the property. So they are basically they occupy the building and they take care of everything. So you as a landlord don't have the operational expense of, you know, worrying about insurance going up because the tenant's paying for it. You don't have the
Hmm.
operational expense of worrying about taxes going up because the tenant's paying for it. You don't have the expense of, you know, worrying about the roof blowing off and having to pay for it, even though you're the landlord. But you know,
Yeah.
the tenant covers all that stuff. So that's an absolute triple net. And then double net lease means that the tenant's responsible for the taxes and the insurance, and then some of the common area maintenance. So we do both. We do double net and triple net.
Okay.
And obviously, if we buy a double net deal, we do our due diligence and analysis prior to acquisition to make sure that the building and structure is in good condition so that we're not on the hook for massive repairs.
Okay. And then yeah, so that's great. And so like to further simplify it, you know, the carryover would be like I have a couple of like single family rentals. So if my renter in that home was paying for all of the insurance, was paying for all of the property tax, and was paying for all the maintenance, the toilets, the sinks, the junk that happens, if they were paying all of that, that would be the, you know, residential single family equivalent of a triple net commercial lease, right?
Exactly. We don't
Yeah.
handle any of the
That would be
operations.
amazing in residential. I would love that.
But
Like,
guess what? We're even better because our leases are paid by multi-billion-dollar corporations.
oh yeah, not 24-year-olds who just got married,
Yeah.
like, or the guy who keeps losing his job every 6 months. So
Yeah.
yeah, sorry,
So
that's
yeah,
what I'm dealing
exactly.
with. Like uh, I probably shouldn't be this nice, but I have a tenant that's gotten 2 months behind, and then they catch up over the course of 6 months, and then it's amazing. The minute they catch up, they get like 2 months behind again.
Oh
So
man. Well, that's
uh,
grace.
yeah, I know, but it's also I'm super busy, and it's just not like as long as I can keep them paying, like it's not worth the hassle for me. All
Yeah.
right, so I'm not the greatest, most effective residential landlord, um, but it's because I have other stuff that's going on. So all right, so that's great. So tell us more about like, you know, and part of this obviously was like this is what you were running, but like when you decided to do something on your own, why did you decide triple net, you know, commercial space, multifamily, which that was like everybody and their uncle was doing multifamily for the last basically decade, right? Up until like maybe 2 years ago, right?
Yeah.
You know, 2012 to 2022, basically. Um, so others separate from current market conditions, right? What was it that made you say, hey, this is where I want to go?
Yeah, so I left that old company in 2023, which was kind of when multifamily was starting to take a shift in the bad direction. So I saw an opening and I saw a lot of investors were sick of multifamily getting
Okay.
burned out and they wanted cash flow. They wanted consistency. They wanted the opportunity to see monthly distributions. So we do monthly distributions and we're able to do that because the tenants are so consistent and stable. So really, I just saw that I wanted to create something that was so stable and consistent and be a part of investors' portfolios that that they um, knew was kind of like the slow, steady,
Hmm.
stable, consistent kind of baseball analogy, aiming for singles and doubles over and over again. We're not aiming for home runs or triples. We are just aiming to get on base and make sure that we have wins, win after win. So I also knew when I started my own company, I wanted my first deal to be a win. So if I'm going to start raising my own capital and raising my own money through investors, I wanted to make sure that I got on base. And this was the thing that I knew the best. And that's probably one of the biggest things is I knew this area the best.
Yep.
And I just don't think there's many people that do it on my level outside of like publicly traded REITs. So I knew it the best and I saw it as an opportunity for investors who wanted cash flow. And I saw it as an opportunity to get on base and to get a win under my belt. So
Yep.
all those things combined were kind of why I did it. And I think moving forward, I'm going to only do single tenant, triple net, and retail for the future, and maybe get into multi tenant, like 2 to 3 units. But I think investment grade tenants and high quality tenants are where I want to be, because there's nobody on the market that does what I do,
Okay.
outside of public REITs, and public REITs don't even have 100% investment grade tenants. So we want to be different. And then really our end goal is to roll up and sell to a private equity group or a publicly traded REIT to strengthen their portfolio. So that's kind of what our exit strategy is build a portfolio that's pretty enough for them to want to buy it.
Yeah. Okay. So I'm probably going to make too many of these, so forgive me if it gets repetitive, but I really want investors to hear why you do what you do. So a lot of the sales pitches, or the benefits that were pitched of multifamily was, well, you have 400 people paying you every month. If one person doesn't pay you, it's no big deal. That's their pitch. So you've kind of gone the other end of the spectrum. You just mentioned single tenant triple net, which means a single tenant, one
Yeah.
tenant, probably in one building
Yep.
that you would own and you have a mortgage on. So talk, and you've touched on it, but explain a little bit more like why you prefer this over even just you saying even multi tenants. You're not even certain you want to do multi tenants, or you mentioned in another interview like, hey, you're not doing these big strip centers, right?
Yeah.
Tell me more about that honing in on single tenant spaces.
Yeah. So the single tenant space, really the reason behind it is because we only want to do investment grade tenants. So we want the best of the best, highest quality, publicly traded, multi-billion-dollar backed leases from investment grade tenants. And an investment grade tenant doesn't mean it's a well-known name like Subway or
Mm-hmm.
Chick-fil-A. Chick-fil-A is not even investment grade. Investment grade means it has a credit rating by Moody's and Standard and Poor's of triple B or higher. And
Okay.
there's a ton that goes into that. So the reason we do single tenant is because that is the best way to have 100% investment grade tenants. So if we had a strip center, we might have, a single, like let's say it's a 4-unit strip center. You might have a Starbucks anchored strip center where you have a Starbucks and then Jim's pizza joint and Jared's laundromat and
And
whatever.
then the 5 a.m. donuts,
Yeah,
or okay, so then
exactly.
you're going to have just significant turnover, or
Yeah, in
possibly
theory. Yeah, and
significant
yeah,
turnover.
potentially. So like for us, the reason we do single tenant is the accessibility to investment grade tenants. And also, a lot of these buildings that are single tenant are 10,000 square foot boxes. So they can be
Mm.
repurposed for a lot of different things. So they're just 4 walls and 8 to 12,000 square feet. And you'll see a lot of times a dollar store move into an old drugstore, or an auto parts store move into an old dollar store. Like the repurposability of these properties is great. And then lastly, we aren't doing one property offerings. Every offering we have is a fund. So
Hmm.
they're funds of 10 to 20 single tenant assets. So in your example of the 400 unit apartment complex, if one of them's not paying rent, you still have 399 others. Well, if we have a fund of 20 properties and one of the tenants doesn't renew their lease, we still have 19 other streams of revenue.
Okay.
So, and we still
So
own the
you're
hard asset.
mitigating some of that just by volume.
Exactly. Yeah. So
Okay.
I would be less inclined to buy one single tenant property as an offering, but since we do it as a fund, it kind of mitigates our risk and diversifies our risk across the board.
Okay. Well, yeah. So that's why you chose that. That's obviously some of the benefits you just went over. So for a limited partner, a passive investor, someone learning about what you do, what are the risks? And we'll not say like in your fund specifically, right? We're going to give Zane the benefit of a doubt today. He does what he can to mitigate all the risk. But if someone else is pitching the same type of deals, what are the questions or concerns these passive investors should have around triple net single tenant type investments?
Yeah, I mean, there's no dancing around it. I'll take. We can say for my funds, what's the biggest risk? Because there's risk in every investment,
Yeah,
and
correct.
I know you're trying to protect me, but I think the biggest risk is that a tenant doesn't renew their lease.
Yep.
So if a tenant doesn't renew their lease, then you have a vacant property where you still own the building, you still own the hard asset, but you don't have a paying tenant anymore. So we do a lot of pre-acquisition analysis into, hey, what is the likelihood of this tenant renewing? What is their commitment to the location? Where is
Hmm.
the nearest competition for this tenant? What could this be if this isn't this tenant? Who could backfill it? What are the traffic counts? Is it on a hard corner? We're really trying to blend three things when we buy a property. We're trying to blend the value of the dirt and the real
Mhm.
estate inherent value of the location. We're trying to blend the credit worthiness of the tenant and investment grade tenant, and we're trying to blend the yield. If we can blend those three things as good as we can across 10 to 20 assets, that's a winning thing. So for us, the biggest risk is them not renewing,
Yep.
but we mitigate that risk by having it in a fund. So having 15 plus different streams of revenue, and also doing our research into like who will this be if it leaves. And then also,
Yeah.
I've been doing this now for 8 years, so I have a lot of tenant relationships where if Dollar General moves out, my first call is going to be to O'Reilly Auto Parts and say, hey, we have a vacant property at this location, do y'all want to step in? So tenant relationships is really big. Broker relationships has been helpful for that.
Okay, cool. Yeah. So that is kind of a nice, you know, again, if we take it even to step back to the single family space, if my tenant that I currently have is not working out, I don't have relationships with other organizations that can place a new tenant, right? I just having to put it out to the world and hope some random family wants the house I have. And so then there's a lot of factors that come into play. Whereas you have relationships with, corporate offices, right, that are looking for new spaces.
Yeah, exactly. So we work with all the major brands, all the major tenants, and we have a relationship with them. Obviously, we're a very small fish. We only have
Yep.
70 or so properties, and there's people who have hundreds, and publicly traded REITs have thousands. So we're a small fish, but it does carry a lot of weight when you already are working with them, and you're like, "Hey, we have
Okay.
$15 generals. Do you guys want to come be our 16th at this location?" So it helps for sure.
Okay. All right. So what about single tenant not renewing? That's going to be, a concern. Any other, questions that, passive investors should be asking about your type of investments specifically,
Um,
regarding the triple net, or maybe triple net versus double, or if it's, let's expand it a little bit and, because maybe to that strip center style investment, what concerns would they have? Like, why are you staying away from that for an investor to understand why? Because what you're doing is not apples to apples with a strip center, right?
Yeah. So I'd say like the first part of your question is, um, I would say like the things to look for on our stuff for the single tenant is maybe like the double net exposure as opposed to triple net. Like some of
Hmm.
our leases are double net, and we are responsible for roof and structure. So just like making sure that the buildings are in good repair. And
Hmm.
as a limited partner, like you're not going to have a huge insight into that, but you're going to have to trust that the operator is doing their due diligence into the building. But if you're looking to invest in these deals yourself, buy triple net properties, double net properties, you'll want to make sure that the building is in good condition and that you do an inspection and PCA report and make sure you get all the right reporting to either get a credit or have it fixed before you buy it. And then from a strip center standpoint, the reason why we don't do those is we don't want to be chasing rents. We don't want to chase rents from, a single donut shop owner operator who that's um, their only business. Like if
Hmm.
they aren't able to make the bills, they're just going to file bankruptcy and get out of their lease. Like it's really easy.
Yeah.
So, that's why we don't do it. So the risk exposure to tenants.
Okay. So what does turnover look like when there is turnover on these triple net style leases? Are you the landlord having to go through and make like the structural modifications, or do tenants typically do that in your type of in your little niche?
On a turnover like TI you're talking about, tenant improvement. Every deal is different. We've never had to pay for TI, so we manage right now 70 plus deals. I don't know the exact number, it changes all the time. We're
Okay.
selling a deal next week and we're buying another one this
Okay.
week. So the number changes all the time, but yeah, we're right around 70, and we've probably had like 6 or 7 tenants not renew their lease properties, so call
Okay.
it 90% occupancy. And then on those 6 or 7 that haven't renewed their lease, we've backfilled 5 of them, and we're already working on the other 2. So, the turnaround has been pretty good. I think owning a good piece of real estate is
Hmm.
really the value. But in terms of tenant improvement, the new tenant coming in has paid for it on all of them.
Okay.
So and that's probably because we're working with these multi-billion dollar corporations. If we were working with Jim's laundromat coming in to occupy a Dollar General, they would probably want some type of concession and for us to pay for it. So that's why we're
Yeah.
very strict on investment grade. But sometimes beggars can't be choosers. If we have a location that we're not getting any bites from investment grade tenants on a repurpose. We'll take what we can and do what's best for investors. So that might be Jim's laundromat, but we would sell it at that point.
Okay, yeah, you'd be looking to place it and sell it.
Yeah.
So, talk to me a little bit about factors that go into valuing
Yeah.
these types of properties, because I mean, I assume that the NOI is going to be, that's the linchpin adjustment based on cap rates, but what other factors go in, and also touch on the things I just said.
Yeah, really, the lease is the only factor that goes into these properties because we own the building, we own the hard asset, and then the lease in place is basically everything you just said in terms of what is your annual rent going to be and what is the tenant responsible for and what is the credit worthiness of the tenant. So there's really two things that drive the value. It's length of lease. If it's 2 years versus 20 years, that will increase the value because basically you're being guaranteed that rent for X amount of years, so length of lease. And then the second one is creditworthiness of tenant. So the higher credit the tenant, the more valuable it is. The lower credit the tenant, the less valuable it is. So if we have a lease backed by Amazon corporate with a 10-year lease, it's going to be worth more than a lease backed by Dollar General corporate with 10 years left on lease, just because Amazon does have a higher credit than Dollar General. They're both investment grade. They both have the same amount of term. They both might be paying the same exact amount of rent, but Amazon has higher credit. So there are even levels to investment grade tenants as well.
Now, this might be too far into the weeds, but is that like a specific formula, or is it more kind of like it goes by the feel and what someone's willing to pay? So it's not a straight equivalent of cap rate and NOI. It is, okay, well, these are the A minus, this is the or AA, or this is A plus, and then it's going to adjust a little bit based on the income.
Yeah, it's definitely market driven. There's no direct formula. I mean, same with even cap rates in multifamily. You'll look at a 6 cap in Dallas and a 6 cap in San Antonio, and they're going to be two completely different assets or whatever. So, it's really just like based off the market. And if you're looking at an Amazon with 10 years, let's just say it's a 4 cap. And if you're looking at a Dollar General with 10 years, might be a 6.5 cap. If you're looking at Chick-fil-A with 10 years, we wouldn't buy Chick-fil-A because it's not investment grade, but those trade at 4 caps. So it's like these deals are very, those two things are what drives it. Creditworthiness of tenant and length of lease is really what drives the cap rate. And the cap rate is obviously based off the NOI, which is annual rent. So,
okay. All right. Question that you may not know the answer to or
Mm-hmm.
can't answer. Why is Chick-fil-A not investment grade? And is it because it's fast food in general, or is it because of the way they structure things?
They're a private company.
Oh, okay.
Easy answer.
There you go. That makes sense. All right, cool.
So
well, that's a nice,
company.
easy, clean answer that's not derogatory about anybody. So
no, they're awesome. I would love to buy them. They'd be a great tenant, but we're 100% investment grade, and they don't have an investment grade credit rating because they're not public. So
because they're not public.
Yeah. So they're a great tenant. I'm not saying anything bad about them. I would love to have in the portfolio. It's a much lower cap rate than we would want to buy, but they're, in my opinion, they're a better tenant than some of the tenants that we have, but they're not rated by investment.
Yeah, they don't fit the kind of with the box you're trying to stay in for.
Yeah.
Okay. All right. So you earlier you mentioned some like factors you can't control, factors you can control, and how you saw that impact some of your prior experience. So, and you've probably kind of said this in a bunch of different ways without specifically stating it in the way I'm going to ask, but factors that Zane can control that investors should be aware of, and that's how you do it. That's probably a lot of stuff you've mentioned. Just give that maybe a quick overview of that. But like, what are some factors that fund managers, syndicators can't control that investors should just be aware of? Maybe it's a little bit of a preemptive CYA, but it's also like, hey, what other things in the world should they be paying attention to that are entirely out of the control of the people who are managing the investments?
Yeah, so things that we can't control, 100%, the biggest one is interest rates, macroeconomic conditions. That's what drives cap rates, and that's what drives commercial real estate valuation. So interest rate is the biggest one. Insurance cost is a big one. Insurance started to skyrocket back in 22, 23. Cost of labor, cost of goods, a lot of that's driven by inflation. Those are kind of the big ones. And then for us on kind of the triple net side, the things that we can't control are interest rates, like I already said.
Yep. Yep.
um, I'd say you can't control like tenants going in a different direction than you expect. Like, let's say you own a bunch of Starbucks and Starbucks says, we're no longer going to sell coffee. We're going to sell alcohol only. And then they plummet because they change their
Okay.
entire business model. So you can't control the operations of the investment grade tenants.
Okay.
And those are probably the two biggest things. You don't control the operations and you don't control the stuff. But for us, there's not really many variables that are a
Yeah.
huge factor.
Well, that's why
Like,
you like triple net, because it
exactly.
removes insurance, it removes, the taxes, which,
Yeah.
uh, especially in single family can kill you because you just don't have the same type of volume going. All
Yeah.
right. So what can someone like you do to protect yourself from something like interest rates, which you can't control? Because that is what really hit the multifamily industry super hard, right? Was interest rates adjusting on them.
Yeah. I think it's all about the debt. If you put good debt on a property that can weather the storm, you'll be in a good spot. I think a lot of these people who put floating rate debt on these deals back in 21, 22, 23 even are getting eaten alive because of it. So
Yeah.
we put debt on our deals that's very competitive and very below market because lenders love investment grade tenants, obviously. So everybody's
Okay.
clawing as a lender, especially in today's market when there's not many loans getting done. All the lenders are clawing at us to get our loans because we are buying really high quality assets. So, what we can control, and that is the debt that we put fixed rate debt
Okay.
with favorable terms, and we can cash flow for however long the loan term is, and typically 4 to 7 years depending on the loan, and flexible prepay penalties, and really structuring the loan on our side is
Okay.
what we do to mitigate our risk for macroeconomic shifts, but also like low leverage, which is also a part of debt, and just buying a good asset is probably the number one thing. Buying a good asset that a good piece of real estate that will be valuable for years to come.
Okay, that's great, and that's so that you use fixed term interest for the most part. I assume those in commercial, are they typically like 15 or 20-year AMs, or do they go longer than that?
Exclusively fixed rate interest, not for the most
Yep,
part.
exclusive. Okay, all right. I didn't want to nail you down on exclusively if it wasn't exclusive. All right,
Yeah,
so
so that's
exclusive.
another variable that we control, and we make sure that
Yep.
it's fixed. And then they're 20 to 30 year amps. Most of ours are about 25 year amps.
Okay. All right. Cool.
Yeah.
Um, and what do you mentioned flexible? That was what a lot of the multifamily guys were saying, like, hey, well, if we do fixed rate, we got this big prepayment penalty or whatever else. So what do those prepayment penalties typically look like? I say typically,
Yeah.
because it sounds like you can negotiate them. What are they? What are you looking at sometimes?
Yeah, so I'll start first with the multifamily stuff. A lot of times you have agency debt like Fannie or Freddie Mac, and you'll have yield maintenance on that, or some just massive prepay penalties. So there's
So what's
just
yield maintenance?
oh,
Describe that for.
I don't even know the exact.
Is that like covering the expected interest they had on the loan, or
I don't know the exact calculation, but I do know that it is a real whammy
okay?
on your returns. So I don't know how they calculate it. You probably want to get some debt broker on here, and they can tell you what yield.
Yeah,
They can try
at
to tell
some
you what
point.
yield maintenance is. But so what we do, kind of a standard prepayment penalty, is 1% for the whole thing. So 1% of the loan amount is how we can get out. So that's what we try to structure because it's
Okay.
fair for us and it's fair for the lenders. Sometimes if it's we do bank debt. We do bank loans on every property, meaning it can
Okay.
be even a credit union, and credit unions
Okay.
have 0% prepayment penalties. I think our least favorable prepay structure is it's a 5-year loan, and it's a step down of 3, 2, 1, 1, 1.
Okay.
So
I've
if
done
we
something similar on single family.
yeah, exactly. So that's our least favorable, but we're not going to sell anything in the first 2 years, so it doesn't matter to us. But 1% gives us flexibility to basically get out and either refi or sell, and roll up and sell. So that's what we do.
Okay. All right. That's good to know. Man, what other questions do you get from, passive investors or limited partners that are good questions that people, especially new to investing like this, should be asking people?
Yeah, I think like the big questions are like, how are you able to do monthly distributions? What makes these tenants so good? How are you lowering my risk? And
Okay.
the way we're able to do monthly distributions is because we have a set fixed kind of rent calendar for the duration of the lease in place. So if we
Hmm.
have a Starbucks with a 10-year lease for $10,000 a month, $120,000 a year, we're going to get that for the next 10 years, no matter what. The only thing that could happen to allow them to stop that is if Starbucks goes bankrupt and rejects their leases. So
And that's why you work with who you work with.
yeah, exactly. So we
It's
don't think they're
okay.
going bankrupt. Is it possible? Sure, anything's possible. I could go outside and get hit by a meteorite, but it's probably not going to happen. But yeah, so we know what we're going to get for the next 10 years, and we know at what rate, and we know what our debt is.
Hmm.
So we basically just take the rental income minus the debt service and distribute the rest. So that's the simplicity behind the monthly distribution cash flow model times 15 to 20 properties. So
Hmm.
that lowers your risk. Um, the other one is kind of how do we mitigate risk for investors? It's really the diversification. Diversification and high credit worthiness of tenants is really what mitigates the risk. Some people say, like, why should we invest with you? For us, our competitive advantage is a few things. One, we've been doing it for 8 years. We have relationships with brokers all over the country, with lenders all over the country, with tenants all in different industries and all over the country. So, like, really, it's just our network. We
Hmm.
get deal flow that most people don't have access to because we've closed on 70 of these deals. So that's a big one. And then an even bigger one is we're 100% investment grade. So, like I said, there's nobody out there really that does what we do from a 100% investment grade standpoint. There are people who have 60 to 70% weighted investment grade because they do strip centers. But we're really the only one on a private standpoint that I've seen out there that does 100% investment grade. Obviously, you have people out there who do triple net medical
Hmm.
office buildings or dental offices or whatever, and they'll sell why those are valuable. But for me, you're still having your lease backed by Don the dentist, and and it's like, hey, dental should be there for a long time. They should be there for 20, 30, 40 years, but for some reason, if they don't, they're one entity.
What
And
happens if he gets hit by a bus?
exactly, yeah.
Yeah.
So for me, it's just like we want to have the best tenants out there, and we want to build diversified portfolios of the best tenants that allow cash flow to investors. So investors who invest with us are typically they're looking for cash flow. They're looking
Hmm.
for capital preservation. And then they're also looking for the appreciation through the lease extensions that we're able to do. And then we also do cost segregation studies on every property, so we get depreciation as well. But for us, I tell investors, I say, hey, I'm not trying to build something that is the highest returns in your portfolio. I'm not trying to be the highest returns. I'm trying to be the
Yep.
most consistent, stable, reliable return in your portfolio that hey, I put money here and it's going to come back. So
Hmm.
that should be that should be a portion of your portfolio. And then still, I think you should go out there and kind of swing for the fences on some stuff, depending on what your risk appetite is. Maybe it's
Yeah.
10% of your portfolio that swings for fences. Maybe it's 1%, maybe it's 50, you know, but for us, we wanted to build, and we are that part of investors' portfolio that is stable, consistent, backed by multi-billion dollar companies, and is kind of their stronghold investment that is kind of their anchor investment, for lack of better terms.
Okay, that's great. And because you mentioned that, like, depending on your risk factor, I'm going to plug Pi, the passive investor event right now. Keith Blackborg is great. He has some really good information about if you're not sure what type of investor you should be, he can help people figure that out. Um, are you the person who should be swinging for the fences, for lack of a better word, right? Or are you at the point where maybe that's not worth it for you? And that's a good question to know the answer to if you don't already know it.
Yeah,
Um,
for
all
sure.
right, so I want to take a step back rather than into the weeds now. Take a step back. When someone is looking at um, private investments, so syndications, funds, what are one or two of the most important questions they should be asking around who they're investing with, as opposed to what's being invested in?
I'd say the first one is how much money are you personally investing in the deal yourself as an operator? And
Yep.
that's not make sure it's not a rolled in acquisition fee, some type of rolled
Yeah,
in
you mean the
fee.
3% acquisition fee they're charging is then the $150,000 that is accredited to their investment?
Yeah,
I've seen that a couple times.
I see it all the time, and I think it's
Yeah.
absolutely ridiculous and crazy.
My money that
Um,
I'm investing is your money that you invested.
yeah, thanks for my
That's
investment.
basically what it is, right?
It's 100%.
I guess it's 100% what it is.
Yeah. So I mean, I think if somebody's not investing alongside you, and if they're not a large portion investor, that they don't believe in the investment. I'm the largest investor in my fund,
Okay.
and I think that's how it should be. And my friends and family are invested in the fund, so I think that's the first question you should ask is how much do you invest in it? And if the minimum on the deal is 100K and their answer is 100K, you should walk out and say, you're only investing the minimum in your own deal, like no, and then you're taking other people's money. So that's the big thing is for me, I think that's the money talks. So for
Yep.
me, that's the biggest one. And then secondly, I would ask kind of like, why you? Why should I invest with you? What's your competitive advantage? What
Mhm.
sets you apart from everybody else? Why should I trust you? Why should I write you a check for $100,000 of the money that I worked hard for? Like,
Yeah.
why should I choose you? And let them sell you, and you kind of have to make the make the decision yourself if that's a good answer. But if they aren't invested, if an operator isn't invested in a deal themselves alongside limited partners, you should run for the fences.
With
And
the same investment class.
yeah,
Is
yeah,
that
yeah,
kind of what
same
you're
investment
saying?
class. Yeah, they should
Not
be a
where they get
limited
a
partner
and
alongside
unless
you.
it's a lower investment class, maybe, but oftentimes that might be more their carried interest if they have a lower level class. So you want to make sure they actually have their own personal cash
Yep, and a good
alongside
chunk of
that's
it.
going to be treated the same way.
Yep, a good chunk of it, in my opinion. And if they don't, then they're just doing it to fill their own pockets. They're not doing it because they think it's a good investment. If they thought it was a good investment, they would be investing in it heavily. And
Yeah.
that's why I created what I created. I honestly, when I left that old company, I just was going to start buying my own properties and start my own kind of fund slowly, buy one or
Mhm.
two or three properties a year. And I basically was like, why would I do this when I can bring friends and family along for the ride with me, and then friends and family and other investors, and buy the same properties that I would buy. It would just be more, and all of us can have diversification. So that was kind of the reason why I started what I did, and why I have so much money in it. So
Okay.
that's
All right.
a little bit.
And you mentioned that y'all currently have around 70, or that's kind of the total that you've, had over time.
Currently have
What's you
currently have 70, and the fund that we're
Okay.
currently raising for, we have 10. So
Okay.
we're building it. By the end of this year, we'll probably have 15 to 20, depending on how much equity we raise. But yeah, shameless plug. If you want to come invest with me, we're currently raising for a deal.
Absolutely. Yes. I want you, if you were interested in hearing about what Zane does, I want you to reach out to Zane.
Yeah.
So did you do all that by yourself?
Yeah. So when I was at that old private equity group, I built 4 funds. And when I left that company, the
Mm.
investors in those funds basically took a vote, and they reached out to me and they said, hey, we want you to run these funds, and we want you to be the one to manage these. So they
Okay.
took a vote and removed that former company as the manager. So they followed me. The
Okay.
funds followed me, and I absorbed them at freedom. So that was about 60 properties. And now we have the 10 in the new property in the new fund,
And
which is our
then
fifth fund.
what kind of team do you have around you that helps you? Because I assume you personally can't acquire 10 more this year and manage 60 other units. So what kind of team do you have built around you?
I just use AI. It's just
Yeah.
me and AI.
Oh, awesome.
No, I'm kidding.
Chat
I have,
GPT does all the work for me.
yeah,
Yeah.
seriously, I honestly don't even work. No, I'm joking. So I have a team of 6 or 7, and we have accountants, we have property managers, we have marketing, I have an assistant, and trying to think what else. I have an analyst who kind of does some kind of outbound gophering for deals, knows what I
Okay.
want, goes and kind of seeks them out, talks to brokers on our behalf, and he analyzes deals. So we've got a good team. And the good thing about these is these 70 properties, since they are double and triple net deals, like they're pretty self-sustaining. Like they run themselves. We don't do anything with operations. So, we'll own deals for we've had deals that I've owned for 7 years,
Hmm.
and we've never heard from the tenant a single time.
That'd be
And
great.
yeah, I know. And they still pay like clockwork. And then we've had deals that we've owned for a year, and we've heard from them 3 times. So it's like, sometimes it's just a manager that's actually running the operations. But, a lot of these deals, we don't hear anything, and the operations isn't there, but we're ready for when it does come and when it is there.
Okay. All right. And so what part of the world are most of these properties y'all have located?
Yeah, so really, we are primarily in the Sun Belt. We're focusing now exclusively really on the Sun Belt. In those 70 properties, we're in 20 different states, but now we're trying to limit them to Carolinas, Florida, Texas, Georgia. Not exclusively, but like that's where we're trying to focus. And we're doing that because our end goal, like I said, is to roll up and sell to a publicly traded REIT or a private equity group or institutional buyer. So we're kind of reverse engineering it and saying, hey, what will these people want when we go to sell in a few years, this fund? And what can we build that somebody will want to buy? And everybody wants the Sun Belt right now. So that's kind of what we're buying.
Okay. All right. Now I want some of these questions are just clarification for me. So someone else listening might have already totally understood this. Uh, but for all you guys like me who need it 2 or 3 times, what are you able to do in the triple net space that appreciates the property, right? So
Yep.
the steady cash flow that's being paid out is basically it's straight up it's rent minus your debt service, and not 100%, but that's the basic formula with some other stuff out. That's cash flow.
Yep.
So how is appreciation created? Is it lease extensions? Is it new tenants? Is it, what does that look like?
Yeah, so it's created really only 2 ways, and like I said, the value of the property is in the strength of the lease. So
Mhm.
we can only do it 2 ways. Way number 1 is through forced appreciation, so through lease extensions. If we
Okay.
can,
So rather than renovating and
yeah,
turning units and putting granite in the multifamily space, like that's their forced appreciation,
yeah,
right?
yeah,
You are extending leases to make the income more certain.
yep.
Okay.
Extending leases for duration, trying to get as much in rental income increases as we can. Really, if a tenant wants to improve their property, they're paying for it. They're paying for, new signage, new facades on the front. We may negotiate that into an extension. We might say, hey, we want a 10-year extension. And then the tenant might say, okay, well, we want a new facade for $20,000. And we might say, okay, well, give us the 10 years and we'll give you the 20K. And that increases the value of our property by 300K.
Yeah.
So, really the lease extensions is the big way we can do it. And that's through our connections. And then the other one is 100% out of our control. And that's just macroeconomic conditions of
Yep.
interest rates and cap rates compressing.
Okay. Okay, cool. So when someone is asking a question of, okay, well, if you're not renovating the properties and you have a 10-year tenant and all these other questions, and they're maybe firmly set in kind of the multifamily space, your value creation on the appreciation that you can control comes from lease extensions and lease rate increases that might be built, that are likely built into those 5-10-year leases, correct?
Yeah, exactly. And then maybe one other thing, which isn't necessarily a value creation, but more so being a value buyer, buying deals below market because we are a legitimate buyer. We do buy deals directly from developers. We have access to deals. We have the track record to get deals at discounts. If we make an offer on a $1 million a property that's listed for $1 million, and maybe we make an offer at 900K, and there's another offer at 975 or 950. If we're the better buyer, the broker is probably going to pick us just because, that's just a round number analogy, but we can get deals at a discount because of our track record.
Okay. Okay. Very cool. Well, dude, all right. You've touched on a couple of things, but why don't you give our listeners just a brief overview of the fund that you are currently raising for and what that portfolio should look like, just so they have a kind of that 30,000-foot view if they want to reach out and talk to you directly.
Yeah, I'd say the very quick pitch is we're buying the highest quality, highest credit, investment grade tenants, and we're building a fund slash portfolio of this. So right now we currently have 10 properties. We have Starbucks, Dollar General, O'Reilly Auto Parts in it, and we'll buy another 5 to 10 by the end of 2025. And you as an investor have ownership across 15 or so investment grade quality assets where you own the building and the tenants paying our rent are multi-billion-dollar companies. And we do monthly distributions, we do cost segregation studies, we have cash flow, appreciation, and depreciation. So kind of fill in all 3 buckets. But really, it's the very stable, consistent, slow and steady wins the race, high quality assets. So we have 400 plus very happy investors across all of our funds, and they're happy because we're still doing distributions while all these multifamily deals are kind of fading.
Correct.
So yeah,
Yes.
so
Yes.
we're stable, we're consistent, and we're backed by the highest quality tenants in the U.S. So yeah, I mean, I think if that's something of interest, the best way to reach out to me is
We'll put it in the show notes, but
yeah,
yeah, you feel free to give it now, but we'll make sure it's in writing too. So
it'll be in
uh,
the show notes, but
it'll be in the show notes.
follow me on
But
LinkedIn too. I
yeah,
post a lot on LinkedIn about what we
yeah.
do. We've been getting a lot of investors from LinkedIn just because I post a lot of the numbers, the details, the math behind what we look for, the kind of the hitting points that we look for on acquisitions. So kind of, I'm
Okay.
not greedy with the information that I have on LinkedIn. So that's a really good place to kind of learn about what we do. And then my email is zane@freedomcre.net. It'll be in the show notes.
It'll be in the show
And
notes. Yeah.
and our website is freedomcre.net. There's a lot of information on there, and happy to help in any way I can.
All right, cool. Zane, thanks for being here. And dude, I appreciate your time and all that knowledge that you were able to impart to us. And I learned new things about triple net stuff today.
Awesome. Thanks for having me on. Appreciate it.
Well, I want to give a big thanks to Zane for being here. I always enjoy when I can laugh with people while we talk business and don't have to keep it too serious. So, if you found this information helpful and you know you need more of this, hit that subscribe button so you get notified when future episodes come out. And if you know that this is something you want to start doing and you're not sure where to start, you are that high income earner, that small business owner, attorney, doctor, whatever that might be. Um, you should check out PI, the Passive Investor event. There is a link in the description below. That is going to be the place to be in Dallas in October. So check that out before it's too late. If you want to go, feel free to reach out to me personally, and I'd love to make sure you get really the VIP treatment. So thanks for being here, and I'll see you next time.